Hi guys, welcome back to the channel. Hope you're all doing well. It's been another volatile month, continuing the 2020 trend. I've got another 3 UK stocks here, which are totally different from one another, and each offer something totally different. I'm away for the next few days with work commitments, which is why this is out a tad early. If you enjoy these types of videos or the overview provided for these companies, please drop the video a like and subscribe to the channel. Stock number 1 is a company I started a position in a few weeks ago, and this is Polar Capital. Polar Capital Holdings are an investment management company who offer professional and institutional investors a range of research-driven funds diversified by asset class, geographical and sectoral specialization. The share price has had a massive sell-off this year, as had certain areas within the market, but overall this company has been a really strong performer over time, still being up more than 50% in 5 years, which is still really exceptional returns. This information and research is all provided by Simply Wall Street for anybody wanting to check this out any further. The overview here shows that it's estimated to be trading at 50% below fair value. Revenue is forecasted to increase 9.5%. Earnings have grown 23.8% over the past 5 years, and finally they pay a high and reliable 7.8% dividend. Yes, that is 7.8% as the dividend yield. The estimated fair value for this company provided here is that it should be a £12 stock, but right now this trades at below £6, making us heavily undervalued in the eyes of Simply Wall Street. Depending on what industry companies are in will affect how we view and value the PE ratio. We know that historically tech stocks trade at more of a premium than to other industries, so looking at the company's PE in comparison to the specific industry is a better way to get an apple-to-apples comparison. Polar Capital has a PE ratio of 8.6 in comparison to the industry, which is at 10.9, and really cheap in comparison to the overall market, which is currently sitting at 17.7. The earnings in Polar Capital Holdings is more of an ascending wave rather than continuous growth, but overall the next few years out to 2024, analysts are expecting revenue to be at all-time highs of £270 million, which will likely coincide with good performance in earnings. The financial health is absolutely brilliant for this company, with both short and long-term assets well outweighing liabilities, which in these challenging times offers an element of safety that we know this company can weather any storm. This good health is mirrored in an all-green balance sheet rating, showing no immediate dangers should we continue in this downward spiral. If you're like me and love a good dividend-paying stock, then this track record will appeal to you. From 2012 up to 2022, they have paid a reliable, high yield that has been stable or increasing year on year, which is hugely satisfying to see. Recent third quarter results have been released, which Polar Capital are pleased with. Total assets under management are sitting at £24.3 billion, up from £20.9 billion at the end of March. This £3.4 billion rise is comprised of net inflows of £800 million and an increase of £2.6 billion related to market movement and fund performance. Its fee performance is at £19.3 million for the 9 months of the 31st of December, which compared well to the £19.5 million it recorded in the 12 months ended 31st of March, and the £4.3 million it reported at the same point in 2020. To get a better view of the historical performance of the total assets under management, results show that this is a combined annual growth rate from September 2017 to October 2021 of 22%, more than doubling from £10.6 billion under management in 2017 to £23.9 billion in October 2021. Financial highlights show that profit before tax is up 17% and core operating profits up 65%. September 2020 profits before tax was £27 million in comparison to £31.7 million in September 2021. If you look at the bottom section where it mentions the dividend per share, it's been increased a whopping 56% in the same period. Polar Capital have an impressive dividend history, with the ambition to be paying out between 55 and 85% of adjusted total earnings. These payments are spread over 2 payments, the interim payment and a final payment, and the combined annual growth rate over the last 3 years for this dividend is sitting at 13%. Market Screener has 4 analysts on this one, with an overall buy rating, average price target of around £1, which would give an 81% increase from current levels. 2 buy ratings, 1 outperform and 1 hold, and I like that this one's a bit of a hybrid stock in the sense that it offers good growth while offering a market leading dividend on top of that. Stock number 2 is more of a high growth company operating in the online security space, and this is Cape Technologies. This company offers products which provide online security, privacy and optimization tools for the consumer system, which we know that this industry and online security theme is going to be an ever-growing market from now and out into the future. Depending on your investing time frame or risk tolerance, this stock may be or may not be for you. Cape Technologies has been a real darling in recent years, giving superb returns over 500% in the last 5 years. The company has followed the market down in recent weeks, which could be a great time to enter, as looking at this chart, any weakness previous has been a good buying opportunity. The overview for Cape shows this is another stock trading at an estimated 50% valuation below fair price. Earnings are forecasted to grow nearly 40%. Earnings grew a whopping 2,000%, showing a huge jump up from one of their recent acquisitions, ExpressVPN, who they picked up for just under $1 billion, and this doubles their customer base from 3 million to 6 million. A few risks highlighted show that the shareholders have been heavily diluted in the last year, and that there was a large one-off item which will impact financial results, with some significant insider selling over the last 3 months. The share price has a fair value price of £6.50, whereas right now it's sitting at just above £3. The PE ratio of Cape is very much on the premium side, as it's sitting at 41. It is slightly lower than the industry average of 44, and it's miles above the market average. The forecasted growth for this company out to 2024 does help justify that premium price on Cape. Revenue is forecasted to skyrocket over the coming years, with expectations that it will have annual revenue of $815 million by 2024. Short-term assets don't cover short-term liabilities, however long-term assets easily cover long-term liabilities. Not perfect, but nothing that jumps out that would make this company uninvestable. Balance sheet health is a flood of green, with one red flag up here, and it's the debt of $123 million, which for me isn't something to be hugely concerned about. Cape released recent results in which they anticipate higher full-year revenue. Previous full-year guidance was about $230 million, representing an increase of 89% over 2020. Adjusted EBITDA is expected to be in line at $77 million, which is a 97% increase. They had strong organic growth, with revenues excluding the ExpressVPN acquisition reaching $212 million, which was 5% ahead of the upper range previously guided. Finally, the group's subscriber base increased 158% to 6.5 million. This information can be seen in a nice straightforward format taken from their investors relation page. Future growth, which we touched on, is to take off like a rocket, and this is continued with the company's own projections. Revenue over the last 6 years has a combined annual growth rate of 49.6%, and revenue to be between $610 and $624 million in 2022. EBITDA has grown at an even more impressive combined annual growth rate of 79%. This visually impressive and easy to follow graph shows that the customer growth rate over the last 9 or so years, where total customers have jumped from under 1 million to 6.5 million as of now. If you want a brief timeline of Cape's journey, then look no further than here. To date, they have completed 7 acquisitions over 5 years, deploying over $1.2 billion of capital on mergers and acquisitions, and I would expect this to be a continuing strategy to consolidate a lot more of these current companies that are participating in the online security space in the future. On tip ranks, we've got one analyst covering this one with a hold rating and a price target of £4.10, giving about a 28% potential upside on this one. A high risk, high reward play here for the long term, which does trade at a premium, but we can't deny the past, present and future growth is truly spectacular. And finally, we have stock number 3, Primary Health Properties. This is a healthcare REIT who invest in primary healthcare accommodation across the UK and Ireland. They invest in real estate to let on long-term leases. The majority of its healthcare facilities are GP surgeries, with other properties to let to the NHS, HSE in Ireland, pharmacies and dentists. The share price for Primary Health Properties has sold off from its highs of about £1.60 towards the end of last year. 5-year performance has been okay in terms of capital gains, with a 26% return. But if you buy this type of stock, usually it's either for diversification, safety or income, as it offers a fantastic dividend. The overview for this company is that it's trading about 24% under fair value. Earnings have grown 4.9% over the past 5 years, and they pay a high and reliable dividend of close to 5%. 2 negative points highlighted in this screen is that interest payments aren't well covered by earnings, and they have a large one-off item impacting financial results. Estimated fair value for this REIT is about £1.77, whereas right now it's in the £1.30 range. This company offers reliable growing revenue from 2019 and estimations that this will continue into the future. 2019 did record negative earnings. This has recovered extremely well in a V-like shaped fashion, with analysts agreeing that revenue and cash from operations will continue on an overall growth trajectory out to 2024. Short-term liabilities do slightly outweigh short-term assets, but because this company is a REIT with the majority of its assets fixed to real estate, long-term assets well cover the long-term liabilities. Majority green dashboard here for the balance sheet health, with debt of $1.2 billion flagging up, but as we mentioned about the last point, this can be argued as being good debt as it's fixed against real assets and real estate. This close to 5% dividend being paid out puts Primary Health Properties in the top 25% of UK dividend payers offering a real incentive for income-focused investors. The same dividend has been growing and stable for the past 10 years, but as we've seen with the likes of AT&T and recently PPL, that previous payments don't guarantee future payments, and that's just food for thought. Recent earnings show promising results, with the company reporting adjusted earnings of £83.2 million, up from 13.8% on a 4.2% increase in net rental income to £136.7 million, which in turn increased the dividend from 5.8 pence to 6.2 pence. Noted in these earnings was that the need for modern, integrated, local primary healthcare facilities is becoming ever more pressing in order to relieve the pressures being placed on the hospitals and A&E departments and to catch up on the backlog of missed procedures. The earnings report cuts straight to the fact, which we'll jump into. The section circled follows on from the point of how important these facilities are, and the bottom line it mentions that having successfully delivered 25 years of secure and reliable growth for their shareholders, we have firmly established ourselves as a sector leader, and the board looks forward to delivering further earnings and dividend growth in 2022 and remains confident in PHP's future outlook. Tip ranks have 3 analysts on here with 2 buy ratings and a hold rating with an average price target of £1.70. This isn't a high growth company, but with contracts tied in with the government and with huge COVID backlogs, it could be a safe place to park your money right now and get decent capital gains over a period of time, as well as a 5% dividend top of that. And this will bring us to the end of this month's picks. I hope you found value in this video and possibly want to do further research in these companies yourself. So thanks again guys, and I'll catch you all in the next video. Cheers.